Well, good afternoon and welcome to our regular monthly newsletter update. Another busy month, about break even in Australia. The US market hit an all-time high again. Interest rates remain stable in Australia. Probably now close to the lows. There's a bit more activity out there. More action in the property market. Certainly, the auction rates are improving, so that should eventually work through to better prices. So probably close to the bottom there. Let's turn quickly to Cyprus. Cyprus is an interesting country. I used to visit there when I was a lot younger. Very much a resort type place. Joined the EEC 7 years ago, and then the common currency 4 years ago, the euro. A lot of money came in from overseas, particularly from Eastern Europe, and unfortunately that became too big for their economy. The net effect of that was they had to go back to the EEC, ask for money. This is quite a small economy, only 0.2% of the EEC, so Economic Union. So the net effect of that was that a line in the sand has been drawn whereby the first 100,000 of euros is protected, but above that, effectively that money is sequestrated for depositors to contribute to the bailout. This is quite significant because this could impact on other countries that historically have been deemed to be too big to fail, countries like Spain, Italy, Greece, Ireland, where they're effectively bailed out. So shot across the bows would probably mean the euro won't grow as quickly as it had in the past. It's a bit like a company over trading. They'll need to tone things down there. There's a bit of a map there in our presentation, so you can see where Cyprus is in Europe and where the next country that might be affected with that. So far the markets have accommodated pretty well, and there's 1 million people involved, which is 1 million too many, but probably won't cause a systemic run there. Turning more locally, the ups and downs of Canberra, we had a coup that didn't quite happen, and the net effect of that was quite a few ministers having to go to the backbenches, left a bit of a hole there. So a bit messy, not great for the media industry, which eventually had the proposed legislation overturned anyway. Telecommunications, a bit all over the place with the NBN at the same time, and now we're 6 months away from an election. Today, finally, we got some outcomes on superannuation. This has been a real thorn in the side for all of us, and it's straight off the press, quite literally, but we've covered those in our notes today. In effect, the main things to be aware of: a limit of $100,000 drawdown per person per annum in a tax-exempt manner, which is still very, very generous. It would mean a capital amount of about $2 million to do that. The pollies have been called as well, so even though you'll read that the net effect of their super is worth maybe $5 million, they will also be paying 15% tax on anything above $100,000. The non-deducted contributions are going up eventually, so instead of being able to put in $25,000, it'll be $35,000 next year if you're over 60, a year later if you're over 50, and a bit of a cleaning up of the problems in the past where if you've put too much into super, effectively you were double taxed. You'll now have the opportunity to take that back as wages at your marginal rate of tax, not the highest rate, or show that as undeducted contributions. It's still got to be legislated, but all in all that's a lot cleaner than we had first feared. We're doing a fair bit of work now on the website, and we're building up our library as well. So it's all systems go. Enjoy the weekend. I look forward to seeing you again soon. Thank you. Bye-bye.